Hi everyone, I made a video in early 2025 reviewing Bell Canada, quickly mentioning it's not the right time to buy, it's not in a good position, and I actually don't trust the C-suite or senior management's decision-making process. Well, this happened a lot quicker than I thought, but Bell Canada cut its dividend by 56%, even after the CEO promising they wouldn't cut dividends. This is why you should never chase high yields. Everyone commenting on my recent videos actually asking why I'm only recommending 5% or 6% stocks, because they're like, hey, look, this one is 10%, this one's 11%. If you want a 12% yield, which is what Bell Canada was when I reviewed it earlier this year, this is the risk. You know, the yield is too high, you risk getting a dividend cut. If you had $10,000 invested, you're reliant or excited to get that annual dividend yield. Let's say you're getting $1,200 a year. Well, now you're getting less than $600 a year after that cut. This is the first cut since I think 2009, where they were steadily increasing and paying the dividends. They've been paying dividends since 1949, but they had a little bit of a pause. We had a good 15 years where we thought the stock was good stock. I thought the stock was good. I thought it was a good dividend investment for your retirement portfolio if you needed something to live off of, or if you liked the dopamine hit of getting a dividend instead of growth stocks. It's fine. I used to recommend the stock, so I've also made a mistake. But before 2009, they had a period of 2 quarters, I think in 2008, where dividends were paused or the increases were paused. The company was supposed to go private, or at least that was the rumor. It ended up falling through, but I think it's likely because of the poor timing of the 2008 financial crisis. But even before that, I thought it was a good investment. But here's the issue. I don't think it's a good idea to sell the stock and dump your losses after the cut now if you've been holding on for the last few years. I do think a cut is a good thing. They'll be saving and banking more cash to hopefully fix, grow, and rebuild the company back up. I only think this is possible if the current C-suite is removed. The person I want removed actually had a few things to say. Let's look at it. If we strengthen the balance sheet, give ourselves the flexibility to invest in growth, these two things in combination will drive total shareholder returns. And on the balance sheet, investors have been asking for the leverage ratio to come down. Yeah, so it wasn't the CEO making this decision. Cutting dividends is really bad, but it's obviously pressure from the analyst. I actually have more questions than answers after going through the Bell Canada news and the call. So they sold 51% of the fiber optics JV that they purchased Ziply last year, just to expand into the US. They purchased this company at a huge multiple, causing the stock price to go down a little, which is fine. Then now they partner with PSP, I'm guessing due to cash management and cash flow issues. So PSP has all the upside now, while Bell has taken or is taking majority of the risk. This is a super defensive play by Bell, and it's not one poised for growth and huge revenue since they just gave away over half the potential upside. One more item, the overall subscribers of their phone plans are down 1.6%. And I hate the commentary on this. They're saying the population isn't growing. It's because of the recent immigration policies causing people to leave and the subs to be down, which is not the case at all. It's a little deceiving. Canada grew 4% in a year by over 1 million people, new people coming in. I believe we had a net inflow of 1 million. So to say subscriber growth is down due to population growth decreasing is a little deceiving. And again, it's management blaming everyone but themselves. I should expect a 1% or 2% growth, but it looks like they're losing subscribers to the competition who are increasing dividends and doing better, but we'll save that for another video. Moving on, a couple things that went under the radar. While Bell still offers a DRIP, dividend reinvestment plan, they removed a big benefit. They eliminated the 2% discount to market price if you enrolled in their DRIP. You can still have your shares reinvested, but you no longer get the 2% discount. But here's an interesting point. If you never understood what the term priced in means or meant, to me at least, it means the stock price already reflects the likelihood of something happening. Well, the stock price has been dropping over the last year, and with the high yield, we all expected a dividend cut. Once we hit 12-13%, I knew this was coming. So how do we know that the dividend cut was already priced in? But if you take a look at the stock when the dividend cut came, the dividend was cut by 56%, but the stock went up by 7% the next day. So not only was the 50% cut priced in, but the cut was actually taken as good news. So the market, I'm guessing institutional investors, are buying and pumping up the stock. But it's hard to believe Bell's stock was actually $72 per share. It's down 56% from that peak, which is conveniently the same amount that they've cut the dividend. But over the last 5 years, they're down 44%. But I'm wondering, where do we go from here? I think everyone's wondering that. Do we buy in? Do we sell if we already have? I'm not too sure, but let's break down a few things. They have $39 billion in debt, which will likely never go away. It's been increasing. So they had $34 billion just a year ago. I'm hoping they can reduce it slightly now that they have all this extra cash. With the dividend cut, they have an additional $1.6 billion in free cash flow. This is on top of the savings from recent layoffs, which I hate to hear. It sucks. Bell Canada laid off 4,800 staff, which equates to around $500 million in total savings. So let's say $2.1 billion a year in free cash flow. I hope they can use this to pay off the debt. Their previous issue was not being able to generate enough cash. They didn't have enough cash to pay the dividends. They had to borrow debt to pay the shareholders, which kind of sounds like a Ponzi scheme, but I didn't say it. You did. I didn't say Ponzi. Anyway, that problem is now avoided, I guess. Now they have a 5.7% or so dividend yield, but I personally wouldn't buy it. I have a hope that senior management is smart enough to put more of an effort into actually fixing the issues, why am I struggling to talk, and growing instead of relying on handouts and blaming policies or increased competition for their failures. It's likely going to take years, let's say 5 years at least, to pass for people to forget and forgive the recent blunders and dividend cut. I think this stock will be slow moving and defensive for the next few years until they can regain everyone's trust again. It looks like, I believe the stats were 50% institutional investors and 50% retail, which is huge. That's it for this video. I'm hoping the next video will be about Bell's competitor who actually raised their video and is doing really well, which is a funny contrast to Bell Canada. But regardless, I'll be reviewing and recommending another Canadian telecom stock next. Thanks for watching and tune into the next one.